forced trading into poor liquidity is what makes volatility events. And the liquidity is not returning. So the value of the positions that are set to expire, 80% of that value is calls. Traders have been holding these puts through this big rally in the spiders, right? And what this tells me is that kindling is still there to the downside. A lot of the close-to-close volatility that is being kind of hidden is zero DT people coming out and helping the market to mean reverse. That April 9th move, we had I think it was a 10% intraday swing, as you can see here. That was the largest intraday swing since, I believe, 2004. Totally bigger than COVID. And as you can see here, our daily moves are sustained at a much higher level.
So Brent, I know you follow the markets closer than me, but I was looking what's going on here, and I thought a month ago or so there was something about tariffs, but then I looked at the S&P 500 and we started recording, and it doesn't seem like there was. So did I make that all up?
Yes, you definitely did, and your returns are better off just doing nothing and buying each and every dip is still the winning ticket, Jack. So it's all good, man. That's the name of our April, or excuse me, our May OPEX now. To your point, it's all good.
It's all good. Well, it's all good is not going to get views on YouTube, so I'm gonna need some bearishness from you somewhere in here to dial it up a notch if I'm going to make the cover work.
Yes, I'm actually quite well. Here's the problem, Jack. I would say, have you been on to Twitter port Twitter traffic? Sorry, port traffic Twitter. That's what I meant to say. Have you perused there?
I've seen a little people talking about it, but I have not been in there. But I've been told the ports are pretty empty.
That's my new doom scroll, and I'm fascinated with that. I have absolutely no insights on this, but watching the boats as they don't come into the LA marina or port or whatever, it's becoming my favorite. Not really pastime, current time activity, and that seems doomish. So if you want some doom, call this port traffic at a standstill, and then we'll get some views.
Apparently, there's a port YouTube channel as well. By the way, there's also doing.
You just watch the boats come in and out.
That is like blown up, yeah, like somehow highlighting that there's no boats in the port or something like that. So whatever. If you and I were port experts, Brent, we could be blowing this channel up, but unfortunately, we're not.
There's an excess returns channel podcast in there somewhere where you could just give us the daily port traffic update.
Daily port traffic. If it comes to that, that's what I'll do. And anything to get the clicks, Brent. But it is interesting to me because, like, on one hand, I can't really explain this. I mean, you think about the pain trade, and the market always does what you don't think it should do, and that's what it's doing. But on the other hand, I do think back to COVID, and I think about like a situation where we had all this negative news that wasn't getting reflected in the market. We had an options expiration. I'm like, at some point, are we going to have that? Like, I can see both sides of this as I think about the whole thing.
Yeah, you and me both, and you're sort of more free to say whatever you'd like to say, I think, than I am in terms of macro standpoints, because my macro views are, I know they're not correct, so I try not to say anything.
Oh, mine are far worse than yours.
But I keep getting that feeling like you're looking, and maybe it's because I watch too much port traffic Twitter, but people are like falling in the streets and like stuff doesn't make sense, and Trump yesterday saying it's good that the truckers got laid off and all stuff, and you're kind of like, oh man, like, I don't know, this doesn't feel good. And then, like, we were talking with Chris Sedil on his podcast, which kudos to you for all those views. The problem with being bearish, at least recently, was everybody was bearish. I think we've cleaned some of that sentiment up. The greed monitor, the fear greed monitor is now greed. I think we were at excess bearishness. So maybe some of that's alleviated, but I'm kind of with you. Like, this feels like we can't be out of this thing already. Right. And so I try to really balance what I see in positioning with that kind of narrative, that gloomy macro narrative that seems to be creeping in.
And that's cool about what we're going to do here is because we are going to rely on data and we're going to rely on what you're seeing behind the scenes. You're not going to get Jack or Brent's macro views, both of which are going to be incredibly wrong.
Right.
So that's what we're going to go on today. And then also, I have to say, as a good YouTube host, stay tuned until the end when you're going to find out why it says Saul Goodman.
That's right.
On here right now, because I don't even know that. So you've got to stay to the end, and you're going to find out what Brent's talking about there.
I'm a big fan of Breaking Bad and the show Saul Goodman, so we'll work that into the podcast. And I just thought about this. From now on, we could do two things. You could give one macro view, and I'll give the opposite macro view, and then you could say always right.
And we'll be right no matter what. That's the whole thing with the if you predict a 40% chance of a major market meltdown, like you're always right, because 40% is actually above the actual odds of a major market meltdown. So you can say you're right there, but it's also less than 50. So you can say you're right on the other side. So it's actually, if you're going to be a forecaster, that 40% chance it always works really well for you.
Right. That's a really good point.
40, so maybe that'll be my title here. Something, the 40% chance of a market meltdown.
That would be a killer YouTube title thing.
Probably not, actually. The 100% chance probably does better than the 40% chance, but whatever. So, but before we get into this, we always like to talk about behind the scenes. Obviously, these options flows have a big impact on the market. You've got a chart here that shows how much more people are using options, which exacerbates these flows. So we have, I think our October episode was one where we went into this in a lot of depth. But in general here, can you talk a little bit about these flows and how they impact the market?
Yes, we're going to weave some of this in when we talk about liquidity or lack of liquidity, but options volumes continue to surge at records. Those, record in March, record in April, 0 DTE record volume. And now the NASDAQ announced that they're going to offer 0 DTEs for the Mag 7 stocks. So more volume is going to come on. There's a big SIBO 0 DTE report that came out that everyone was talking about at the OCC conference I was just at. So more and more volumes are coming in. And obviously, if you want to see a nice stock chart, you can look at the SIBO chart, because when the market crashes, people buy puts and VIX calls and volume goes in. And then when the market stabilizes, people flood into 0 DTs. And so they are winning 100% of the time at the moment. So these volumes, just when you're adding more products, there's just no reason for it to stop, right? And so that is the tailwind that we have in reading the options market, because the bigger volumes should mean more impact.
Yeah, in this next slide, we talk about this sort of path here in this flow.
Yeah, and the way this generally works is everyone jumps on their trading platform, be it retail people or hedge funds or whatever it may be, and 90% of the orders that we send to the exchanges are facilitated by a market maker. So you take all of these small orders and they add up to big exposure. And so the market makers are required to offer liquidity on the exchanges. And so they're sitting there, and all of a sudden they could end up buying or selling a bunch of AMC calls in this example. I should update this from AMC to something more pertinent, MicroStrategy maybe. But the point here is that we can get some basic assumptions around how much underlying flow that leads to, right? So in this case, we had 100,000 calls being bought either by retail or a combination of retail and hedge funds, whatever it may be. And if you look at the delta of that, so it's the hedge ratio. In this case, we use a 50 delta as an example. Delta ranges from 0 to 100. That could be as much as 5 million shares to buy. And that's just the initial hedge. That hedge has to be adjusted as AMC price goes up and down, as time passes, as vol shifts around. And so as those dynamics change, they have to adjust the shares. The market makers have to adjust the shares they're buying and selling all day long, kind of every day. And so that is how the options orders kind of start to work their way into how the underlying stocks that we're watching move.
So before we start on what we looking back here, I wanted to ask you, what's the update on Captain Condor? Is that in the presentation, or what's he been up to?
Captain Condor did poke his head out. He lost a few rounds, and so his size got up to be about 50,000 or 30,000, I guess it was. The Wall Street Journal article came out about Captain Condor also a couple weeks ago, so that got up a bunch of attention. But he's been suspiciously quiet as volatility has spiked. And so I thought that's interesting. From what I've been able to tell, Captain Condor actually doesn't seem to use vol or options prices as a trigger to trade. Seems to be more like a technical analysis, and then he enters this option spread trade, which is interesting. But he has admittedly been quite quiet, even though volatility has been higher, which to me is interesting. Because you'd think when vol is higher, you'd want to sell options more in that type of environment. But
that's not a sign he blew up or something, is it?
No, he didn't blow up. He's won again. But he seems to constantly kind of escape death here. Basically the rub is, I think the most he's been wrong is about 5 times, meaning 5 days in a row he's put a trade on that's lost. I think if he got to 6 or 7 days, then the amount of capital he would need to support that trade would kind of skyrocket. And there's convexity there because he doubles down right every time he loses. And so it's called the martingale betting strategy. And so as you know, with martingale or playing blackjack and doubling down, at some point either you run out of money or the bank comes out or the casino comes out and says, hey, no more jack. We're not on the
regularly in everyday life.
Yeah, you like to sling it over there at the Mohegan Sun. I heard.
Yeah, I do. I slip down in the middle of the night, when the kids are sleeping. Throw it all down. Well, anyway, back to this. I always have to ask about Captain Condor. I know you were involved in the Wall Street Journal article that outed him. So we always got to make sure he's kind of become a role play in the podcast. So we got to make sure that we always know what he's up to.
That's right. And we're constantly looking for someone else to name around here. So as soon as we have some more names to dish out,
you're good at the names too. When somebody comes out, you're going to come up with something good.
We're trying. I got that from Macro Risk Advisors. They named remember 50 Cent back in the day. The VIX traded up just by 50 cent options, and I always admired that they were able to get that guy, so much attention. Turned out to be I think a French quant, about as far from 50 Cent as you can get. But it's a cool name.
So, anyways, as we move on here, this next slide, we're looking at the OPEX cycle and how it works.
Yeah, the way that this works is options positions build into the monthly expiration in general. And so the monthly expiration is the third Friday of the month. So as the options positions build at that third Friday, that's next Friday, the 16th in this case, hedges associated with those trades build, and then options positions expire. And then the hedges that are associated with those options positions shift. And so as you can see here, there's a lot of expirations on this chart, but some of these expirations are really pivotal. They tend to be the quarterly expirations. So we have big eyes on June expiration, which is next month. But they can be real turning points because you could take this extreme positioning either on the call side or the put side, you clear it out, and then hedges associated with those positions again are removed, and volatility can change and market direction could change around those expirations.
Yeah, and looking back to COVID, I mean, that's obviously the most obvious example on the chart of looking at these things as turning points.
Yeah, February really unleashed the downside, as you can see here, and then March, it was the day after March expiration that we bounced. You can look back in 2022, there's a major low associated with that as well. Last year in 2024, the quarterly expirations again. So you can go through all these dates and find, key turning points. And as we'll see here shortly, there was a brief drawdown after the April expiration, and this May one is really an interesting moment, which we're going to dig into here in a few slides.
Yeah, so on this next slide, you're looking at how we're setting up heading into May here.
Yeah, and to your point, Jack, earlier, if you're going to tell me what happened, we did have that extreme early April volatility and went through April OPEX, which removed some of those positions, but there was still a lot of volatility there in mid-April. And now what you see here is almost all call positions, right? If you go through the index stuff, so at the top here, the index stuff is NDX, Russell, primarily are those two big index positions. It's 80% call delta. So the value of the positions that are set to expire, 80% of that value is calls. ETF, same thing, 70% single stocks, Tesla, Apple, blah, blah, blah. 70% of that value is calls. In April, this was the opposite, right? We were more towards the put end of the spectrum. And so this to me is fairly surprising. That was the word I was looking for. We have had a 9-day rally. We had a big 10% drawdown from the recent low. So there has been a lot of bullishness kind of built up here. But the fact that we are so skewed to the upside, to me, is one reason that I think May could mark a short-term high in the market.
And is that some of that is because the market's up, right? So the value of these positions just goes up when the market goes up. But also some of that is probably people are legitimately buying lots of calls.
People are buying calls, and because the market rallies so much, those call values increase, and that's what drives this. We measure this by delta notional. So remember earlier we referred to delta as the share ratio. You can also look at delta as the share equivalent, right? So the larger the delta is, the more value in stock terms that you see out there. You're going to see Goldman and push out some numbers that'll be like $5 trillion OPEX because they're assuming one option is worth 100 shares of stock. And when you look at it through the delta notional lens, what we're saying is, no, this option is actually worth, 50 shares of stock, not 100 shares of stock. And that's kind of how we break this down. So we think this is more accurate. But the point is, to your point, market rallies, call values increase, and at the same time, you would sort of expect there to maybe be a little more put selling. Those puts are losing values as the market goes up. But I would just expect in this environment that should be maybe a little bit more hedge flow. Maybe people would be more actively monetizing some of these positions. It's just interesting to me that it is so skewed. But again, if you look at the last month's performance, as we could do right here, we could see that it's just been nothing but up really since April OPEX.
So on this next one, we're looking at this expiration, and you can tell it's pretty small at least relative to what's coming up.
Yeah, and this is not a bad size for a regular monthly expiration, but it's the quarterlies, and I mentioned June before. You can see this is June. Here we're measuring single stock delta. So again, blue is calls, orange is puts in terms of that delta value. So more calls value certainly expiring versus puts, and then the June is the really big one, right? So if we were to rip into June options expiration or tank into June options expiration, I would be looking, and we'll be talking about this likely next month. This is a much more significant position, right? Or significant turning point, I think, possibly coming out of June versus May.
Will I get to break out my largest options expiration ever cover for June, or is it not going to be competing for that?
No, I think we could break it out regardless. We can always find some stat that supports your.
Yeah. But it probably will not be like one of the biggest ones ever. Or I know we've had some of the biggest ones ever recently.
A lot of that is path dependent, meaning, if we have a big move, right, higher or lower, that drives those options values, drives those volumes. So it's absolutely possible given the, the increase in volumes and all that. But if we just sort of trend sideways, then maybe we don't have a lot of reason to add new volumes on, right? But that potential certainly is there.
So on this next slide, we're looking at gamma and realized volatility, and we are not as far left as we have been.
That's right.
We finally moved a little bit more to the right here, which is where we've been used to over the last few years.
And the deal here is we measure S&P gamma. So how much gamma is in the S&P 500 index. And the more positive we are on this index, the more volatility we have on a forward-looking basis. So it's predictive. And to your point here, when markets are crashing and put positions are relatively larger than calls, we end up on the left side of this chart with a bigger negative gamma position. Negative gamma tends to say, hey, volatility is going to increase in the future. And so you want to be wary of that, right? So we're drifting towards the right on this chart. The market volatility, as we'll talk about here shortly, has been coming in, and things have been a little more calm, right? Back to the Saul Goodman reference. Nothing to see here as per the May price action.
So would we expect, like, once this expiration clears, like an opportunity for a little more volatility?
I believe so, because we're going to remove a lot of these call positions, right? And there's a lot of reflexivity in these positions. So if you are a market maker and you're short call options, right? Because Jack, you've been buying tons of calls, I'm assuming. So when the stock market goes up and a market maker short calls, they have to continue to buying stock, right, into those highs. And when the market continues to go high, they buy more shares of stock. And as the stock goes up because of that, they have to buy even more shares. So there's this reflexivity in it that helps momentum to continue. And so, you know, that is a big driver of this recent price action. And per the expiration chart, this one here, we're going to remove a lot of those calls, right? So that momentum really starts to get zapped. We're also going to talk about Vanna or implied vol as a flow as well, and that to me also seems zapped as kind of an upside momentum tool. So, you know, we really need a deal, a possible China trade deal, which is coming up, you know, this weekend. Maybe they advance that. We need something to kind of keep that momentum going. Otherwise, we're sort of floating in the upper atmosphere without a rocket pack.
When is the VIX expiration this time?
It is after expirations on the 21st. And so what you can see here is that we tested this out, and the deal is here that we talk about flips, right? So if the market is rallying into an options expiration, it tends to sell off after 2/3 of the time, as you can see here. And that's true when VIX expiration occurs after options expiration. That's what we have in this situation. Otherwise, we're closer to 60% chance of a flip. And so since we have such a strong directional rally into this May OPEX, there's a great chance, I think, that we do actually kind of sell off or have some consolidation after this expiration. Of course, that's going to go up against this China-U.S. Meeting this weekend to advance trade talks, and then we have CPI next week as well. So there's a few macro data points that may mess with my stats here. But statistically, you know, we seem to be lining up for a reversal here.
Yeah, I think with any data you look at with the market right now, you've got to like take it with a grain of salt that like any day there could be an announcement on either way that has just a massive impact. It's very hard to look at any of this stuff right now when something can change so rapidly like that.
Yeah, and that takes us to the Saul Goodman. And for those of you who have never seen Breaking Bad or the Saul Goodman show, he's having a hard time, so he changed his name to Saul Goodman because it's all good, man. And that is what you see here when you look at this chart, where we rallied 9 days in a row. I think that was the biggest string of days rallying in something like 20 years. I forget the exact metric, but we've exactly closed the tariff deadline Liberation Day gap. And so to your point, if you went to sleep and slept through April and basically just woke up a couple days ago, nothing happened, right? And now, you know, Trump may give kind of some nastier tweets out there like, hey, today should be 80% tariff sounds good for China, and market doesn't really react to it as much, right? Clearly people are getting more bullish. We were talking about the fear greed index, right? We went from extreme bearishness to greed actually right now. Bitcoin is ripping. It's over 103. So everything seems to be Saul Goodman at the moment. And so that is the way people are choosing to see. People who have not looked at port traffic Twitter are feeling pretty good about things right now.
Well, I was hoping you were going to go like at minute 42 with Saul Goodman because I need people hanging on by a thread to give me the watch time. So I was hoping you weren't going to
be back towards the end of our presentation.
All we've got now is our engaging personalities to get people through the rest of the sprint. So I don't know if we can pull that off or not.
See the views drifting away.
Literally like a big downward spike in the chart right now. But anyway, so we always like to look back.
I want to also just add quickly that I made you wait 15 minutes while I added the Saul Goodman slides into the.
You did. It was an essential part of the presentation. Right. It was very important you did that.
You had a lot of grace waiting for that.
So anyway, we always like to look back at what some of the slides we looked at last time before we look forward.
Yeah, we like to check ourselves before we wreck ourselves. Just going to continue driving this show into the ground. Last last month it was about kind of the known unknown. So Trump pushed off 90-day tariffs. We had entered kind of the edge of the abyss with the huge VIX spike. Treasuries were doing weird things. It was really kind of a nasty, nasty period. And the 90-day pause gave us some breathing room. And we did see the market turn a little bit at April OPEX. It gave back, a little bit of performance, a little bit of weakness, and we bounced from there. One of the big things about April OPEX was the dry up of liquidity, right? Liquidity, and this is a CME E-mini depth of book. It had, and per note in Goldman, I think it was the lowest liquidity we had in something like 20 years. So that liquidity dried up, volatility spiked. It was really quite nasty heading into April OPEX. And our general view was, hey, vol should come in a little bit because we're no longer on the edge of the abyss, but we should maintain some type of vol premium. And, if you were just to kind of, scroll through our general thesis here, we thought that vol would come in a little bit. I think that you can see here we're looking at the market rallying a little bit more into the 5,400, maybe 5,500 area. And so we definitely moved above, I would say, where I was expecting based on some of the volatility metrics. Right, the squeeze has been a little bit stronger than I think than what I saw kind of in the cards here. So normally I kind of like to say, hey, look at us, we got everything like pretty accurate here, but the market did certainly shoot above the bounds that I saw in the options prices.
Yeah, and for people who want more information on that liquidity thing, we talked to Chris Sidiel a lot about that podcast you and I recorded last week, and he had a lot of, it basically echoes what you're saying, but he had some interesting behind the scenes stuff of what he's seeing with liquidity as well.
Yeah, and this is going to come up here when I do some projections here in a few slides. And the interesting thing I would say is you could see that traders were definitely selling some puts, but that made sense off of that record volatility. The VIX was still around 30 into April OPEX, and so that did get sold off, and vol overall has come down a bunch, as we're going to talk about here shortly. But the idea of volatility normalizing to higher levels is still, I think, present, right? And we're going to talk about that dynamic a little bit. So on the volatility space, we've definitely come in a little bit more than I thought we would from those April OPEX. S&P's, about 200 handles, probably higher than I was really expecting. We're sitting here at the 5650 area. We were kind of pegging 5500 as maybe the real high. So we overshot a little bit out of that April OPEX. And the last kind of thing that we kind of stuck these slides in here was on gold, and the idea that implied vols in gold were just starting to get really quite rich. And you can see it in this slide here. And so gold actually did come down pretty sharply. And this is going to be relevant because we're going to talk about Bitcoin right at the end of this as well. So the idea here is that how can you forecast when an asset is just kind of overbought or oversold? Well, if you look at options implied vol, that could be a really interesting signal. And so gold has kind of peaked a little bit over that 300 mark in the ETF, GLD ETF, and has definitely come in a little bit since we saw that signal.
I'm just happy you didn't ask me to do that gold call, like the gold from like the soccer that you put it like that, because I don't have the voice for it.
I was going to go with the Austin Powers I Love Gold. If you could do one of those, would be.
I can't do that either. I got to keep things straight here, Brent. But so as we look forward, what are you seeing here? We got the not so Saul Goodman.
Not so Saul Goodman. This is Saul after he messed with the drug cartels and the gangs and everything else. And now we're playing with tariffs, where you get a bunch of that's the analogy here, right? You play with tariffs. Tariffs look good, and then if it doesn't work out, we're gonna end up with Saul not so Goodman. And so why do I think we're at risk of not working out? I'm trying very, very hard not to let any port traffic Twitter views make its way into this presentation. So we'll see here. I mentioned earlier, as we look forward, we closed the Liberation Day gap, which is that red line. S&P actually, looked like it was going to bust straight through this yesterday. That would be Thursday the 8th, when Trump said, hey, we got a UK trade deal and I'm going to back off on China. And then he said, you all need to buy stocks. And then a few minutes later, he called Jay Powell foolish. And then, so it's kind of whipping back and forth here. But it's interesting to me, the market really has stalled at this 5,700 level, which is that gap close. I'm not a technician, but this is where the options, zero DT options are being sold. And that's adding a little bit of local or short-term positive gamma. And the market is really having a hard time digesting that.
Yeah. The Fed meeting, by the way, was just kind of a non-event, right? It didn't seem like much happened there.
It was a total non-event. To me, that wasn't bullish, because it just seemed to be like, we don't really, we're not really sure what to expect here. I don't know if CPI. I mean, it's hard obviously with the Chinese U.S. meeting again this weekend, and then we're going to get CPI. You know, the worry here is that inflation picks up, and then what do we do with rates and all that? And you know, Powell's just sort of like, I don't know. Well, we'll see, right? And I thought that the market would have maybe a little bit more of a negative reaction, but funny enough, as soon as that press conference, you know, ends, Trump comes and says, "Hey, I got a huge announcement tomorrow," and then a huge announcement, you know, coming up this weekend, and blah blah blah. So maybe the Trump pump kind of pasted over that in the short term.
Was there less hedging into that meeting? Were people pretty hedged in that or no?
No, the implied move for the Fed was less than 1%. And if you remember back, we had non-farms payrolls last week. The implied move for that day was 1.1 or 1.2%. So people weren't honestly expecting that much. There was a fair amount of intraday volatility, you know, around that print, but honestly, the market just sort of slept through it. And my take on this is that it doesn't really matter what Powell has to say because we really just need to see this data. Like, are we going to get inflation and unemployment, and then people can just assume Powell will react accordingly, right? And if a trade deal comes, then maybe it doesn't matter what short-term macro data says because we got a trade deal. So I don't, you know, you talk to a lot of macro folks that can give you better, you know, feelings about that. But I can say that the options market is just pricing lower volatility in the future, kind of like everything's, you know, all good. So that to me is the really interesting part here.
Yeah, and I think even the macro guys are kind of throwing up their hands right now. They're like, we don't know what the next tweet's going to be. Like, what could we do about this?
Yeah.
Like, at least when they're trying to predict inflation, they could use some data, like some historical data to try to come up with something. Like with this, like, who knows?
Yeah. And, you know, the funny thing is that if you try to say, well, when did we last have, I don't want to keep talking about the port stuff, but, you know, you go back to these dates, right? Like COVID and some of these other moments in time where, you know, that stuff didn't seem like it was going to go pretty well. And, you know, do you want people to lose their jobs to get rates down? Because that's all part of the 4D chess thing. I'm not sure. But what's nice about the options market and the options pricing is it comes down to risk reward, right? And the risk to bet on the market slide has come down significantly in the last, you know, couple of weeks. And so, you know, to me, that's where kind of opportunity starts to open up because I have no idea about what the macro is going to bring, but I know I can bet on sort of tail moves now at a much more reasonable price.
Yeah, I'm gonna have to put like I can put new backgrounds on behind people on our program now, so I'll have to put like empty port behind you. As like your background
Full myself, yeah.
Right. So you could just take a deep dive into port Twitter or wherever you're going down. That's what we talk about from here on out.
Oh gosh, people.
So this next slide, you've got this idea of negative gamma and how it works both ways.
Yeah, and I'm gonna go through the rest of it without saying the P word again. So let's talk about gamma. What you look at gamma, what you're seeing here is this is part of our new system that we rolled out about a month ago. Honestly, we launched our new product on April 9th, which is a pretty good day to launch a product. That was, for those of you who weren't keeping score, the biggest S&P move in like 20 years. Anyways, so we have this GEX line, right? GEX or gamma line. And if this goes up, it's positive gamma, which means the market should be supported by dealer hedging flows. And if the line is down, then it should be, then volatility should increase, right? Remember that scatter plot earlier. And when you look at this, what you take away from this is that you see these positive bars here and the fact that this line is shooting higher at lower strikes. That's telling us that traders, that means buy side, have been selling puts through this environment, right? And that has been a great trade, right? Because vols come down and the market's rallied, that's great. But if there's any weakness, right, if the market starts to turn south, if China, U.S. end up fist fighting at their negotiation table this weekend, there is no long put hedges that are in this market in terms of the SPX positioning, right? Similarly, if you were thinking that everyone was positioned for massive upside, you would look for this negative gamma, which we're seeing. But as you can see here, Jack, this line, the bottom of this line is right around 5,800 in that general area, and then the line shoots markedly higher after that. So what that tells us is that there's some traders that are long calls in the kind of 5,800 to maybe up to 5,900 area. But there's not a lot of positions here in the SPX saying, hey, I think that this thing is going to rip up, you know, all-time highs by the end of this year. There's been some light positioning coming in with that in that respect, but the thing that I really watched for, you know, the soft spot in this market to me is these short put positions, right? Because what happens in this situation, if you're short options in the market after we've been up 10% in a month and VIX is now at kind of 1 to 2 month lows, if the market starts to slide at all, those people have to cover, right? And when they cover and people start to enter into long puts, right, because they want to hedge some new event, then there's a lot more downside to be had in that type of an environment. So it's kind of like the old saying, a well-hedged market doesn't crash. That's kind of this situation to me a little bit, that this is not a well-hedged market. This is sort of a risky market in the SPX. The other thing you can see here is there's some pretty big call sales in here. And we look at call sales, they generate positive gamma in the market. Those are oftentimes big resistance points. And so in this case, I think those call sales are at areas where the market sees, okay, this is sort of fair value, maybe, or best case fair value. And that 5,900 to maybe 6,000 area, we've seen people sell calls into earlier rallies. And that's that big round number syndrome where, I think even if we do get some kind of a deal or positive talks like that upside into June OPEX is really the area that I'm looking, because these call sales are being made at that level.
So what are we seeing differently in the next chart?
Most people, if you were going to say, hey, I only look at SPX because that's the institutional flow, right? But there's a ton of very large positioning in the spiders. And in this case, the notional value in the spiders is much bigger than the SPX. And not only that, remember this slide here shows positive gamma below, right? And this is about, it's roughly flat. So this purple line here is on this left y-axis. So it's kind of flat to maybe minus $100 million, not very much. If you look at the spiders, we're at minus $2 billion in terms of gamma. So that's gamma per 1% move. So what this is telling us in the spiders is these are all put positions, right? I'm going to show this in a second. But this is huge negative gamma to the downside in the spiders. So what this means is that if we start to sell off, the spider hedging flow is somewhere in the tune of about $2 billion per 1% move in the S&P. So every time we go down 1% in the S&P, there's another $2 to $3 billion of stock that has to be sold by the market makers in this instance. Further to the upside, as you've seen to that kind of same level, like 5,900 or 590 up to 600, those positions really wane. And this tells me that the bull fuel really dies off as we rally into that 590 to 600 area. So for me, into June OPEX, this is a major resistance area, that 590, 5,900 to 6,000, right? Depending on whether you're looking at spiders or S&P. So if you look at SPX, you say not much risk. If you look at spiders, you go, that's a lot of risk. And typically you think spiders are more driven by the retail side of the equation. Makes sense to me. We have a hard time breaking out, retail and institutional buy side in our data, but this is the embedded risk that's in the market in terms of really invoking downside. And then we would assume that institutions have yet to really hedge is the other takeaway here.
So the idea is we could have, if we start going down, we could have more risk to the downside than we would have fuel to the upside if we started going up. Is that fair?
Yeah. And what happens when the market is dominated by puts? And so this is the spider positioning. Blue negative bars means the retail traders, and some funds are in here, we're likely too, they've bought puts. So market makers have sold them. So this is the market maker view of the equation. So if the bars are negative, that means dealers are short these puts or market makers are short these puts. And what's fascinating is, again, we're at 570 roughly in the S&P. Below here is all puts. And what's fascinating to me about this is that the market's up substantially, right? 10% over the last couple of weeks. There's no call options there. So traders have been holding these puts through this big rally in the spiders, right? And what this tells me is that kindling is still there to the downside in the spiders, and that call buying or call trading is not really invoked in the spiders in this case until kind of higher strikes. And to me, this is interesting because if you think about short covering, right, and we talk about Vanna oftentimes, if there are these spider puts and implied vol is coming down, right? The VIX is dropping as an example, and the market is rallying. That is a terrible situation to own puts in, right? Put values get crushed in there, and that invokes what we call Vanna flow, right? When vol comes down, put values lose, and market makers have to buy stock in that situation. Then they'll have to also buy stock as a function of the fact that the market's rallying. So when you look at this chart, and there was a somewhat similar chart in SPX in the weeks ago, right? You start to get the feeling that this was a tremendous kind of put cover or short cover in this index flow in the S&P. Now, clearly, per our first chart in the single stock side, there was some call buying in the single stock side. But when we're looking at this index flow, this is very unusual to me that these puts still exist after this big rally. They've obviously been very beat up, but it gives you this feeling that there was a big kind of index short cover that must have added a lot of fuel to this rally over the last couple of weeks.
So would this give me an idea, like this lack of calls, that there's not a belief in the options market about this rally?
That is the takeaway that I have. I think that a lot of the positioning, look, earnings overall, I think were pretty good, and we've seen some tech earnings and some reflation in there. So I think it's hard to say, hey, this is all a short cover, because clearly there was some calls bought in the tech space. There's a lot of short dated volume. We recently had record 0 DTE volume, which wouldn't show up in this chart necessarily, but I think there's a lot of short dated momentum traders coming into a lot of these positions. So the way that I'm sort of looking at this is that there's longer dated put holders and there's a lot of short dated kind of momentum trading, weekly options, 0 DT options being traded on the index side. And when you have, again, this sort of tinder, it's like this was a real supportive flow. This put crush was a real supportive flow to the market, and I think it's part of the reason that we are able to have 9 days worth of rallies, because these puts stayed in place, and they've just been just destroyed as the market has rallied, but they're still there, and they can reflate if vol starts to spike and the market starts to slide back lower.
To your point on earnings season, this has been a really interesting earnings season, because on one hand, we're reporting earnings that had nothing to do with this whole situation, because Liberation Day was after the earnings.
Yeah.
So like on one hand, we have that. And then on the other hand, like in terms of guidance, like a lot of companies are just kind of throwing their hands up. They're like, yeah, whatever, you tell us what the guidance is.
Yeah.
So you're not learning a lot, I don't think, out of this earnings season.
Yeah, I mean, I think that's totally true. It's like we just pulled guidance, and a lot of times that seemed to be enough for people, and then it would be like, well, we're gonna remove, we may reduce like chip exports or restrictions and some stuff like that, and that gets around. So a lot of that seems to be based off of people looking for an excuse to buy, and it's like lack of bad news was the only excuse they needed, and that's worked out now for this past month. But Microsoft really solid earnings, and Meta and all that, and so if you just look at the response to the earnings, is clearly very strong, and those call positions have built up. So there's been a lot of momentum in this rally. I think that's a function of poor liquidity. I can talk about that here in a second. But there's not a lot of hedging in the market right now. The only thing that I can find that's of interest really is this spider positioning, which is material. But again, the SPX, where the big boys play, if anything, they seem to be sitting here kind of short puts, and and that offers like a little bit of support. But in a material risk off situation, that cover flow could really add to this downside. And you can see in this case, the negative gamma in SPX, when it gets larger, you're talking $4 or $5 billion, right? So that can be much larger, even though right now spiders is kind of the bigger of the two.
Okay. So this next one, you have realized vol has been sinking, which we've definitely been seeing. We had that big spike, and now we're kind of back to back to lower levels at least.
Yeah, per our April notes, we thought that, hey, look, vol should remain elevated, right? It's kind of this new vol regime is really what the takeaway was, that this tariff era we've entered a new vol regime, and so that commands a little bit of premium. And then in this case, what you can see here, 10-day realized vol, it's absolutely been getting crushed, and we're actually now below levels seen in kind of December or in January. So we're kind of moved from a realized vol perspective to before the early April crisis. And the VIX is right now, as we're discussing this, at 22. So 10-day realized vol, which is a kind of a medium term in this time term in this day and age, that's around 16 or forecasting 1% daily moves. And so when you look at this, you kind of go, crisis over, arguably. And then when you compare the spread between these two, you go, well, VIX is at 22, realized vol is at 16. That's a pretty healthy vol premium. Typically the spread between those two is closer to 3 or 4. So if we've got a 6-point premium between the VIX at 22 and realized vol at 16, that seems like a pretty good padding, right, for implied vol, or a pretty good risk premium, you would say. But this number is very strange to me, and I'll tell you this is why. This is the daily range. So what I did here is I take the S&P high for the day versus the low for the day, and I compare that versus the open. Now, in a fascinating measure is that April 9th move, we had I think it was a 10% intraday swing, as you can see here. That was the largest intraday swing since, I believe, 2004. Totally bigger than COVID. And as you can see here, our daily moves are sustained at a much higher level, right? So the intraday volatility is still massive, as you can see on this chart. even though the close-to-close volatility, which is what this measures, seems to be smaller. And at the same time, we're having record 0DTE volume. We just had 67% SPX 0DTE volume last week. That is just keeps going bouncing higher and higher and higher. And so I think that a lot of the close-to-close volatility that is being kind of hidden is 0DTE people coming out and helping the market to mean revert. So people always ask me kind of what's the impact of 0DTE. I think this is part of it, right? You just sell calls or sell puts, and you kind of like force the market to mean revert, right? As a on an intraday basis. And so those traders, if you consider these big swings and they help the market to mean revert, then 0DT trading could be quite profitable if you're positioning to get that, intraday mean reversion. But that is all that this realized vol is hiding this big trading ranges that we're seeing. Does that make sense?
Yeah, it makes complete sense. There's nothing with realized and implied vol. There's nothing rule that says when they separate a lot, like one usually pulls the other in its direction, right? It could really go either way.
There's no rule, and historically, you look at 1 month realized vol and you compare that to the VIX, because the VIX measures kind of 1 month forward volatility, implied volatility. In this case, I had it set to 10 days because I wanted to take that big jump right from early April out of the matrix, so to speak. I could expand this a little bit, but 1 month realized vol is a little bit closer to 30, so it's still quite a bit higher. And if you look at the spread between them, again, historically it's about 3%. But the rough idea, if you're just going to put your finger in the air and say, is vol too cheap or too rich, you would compare the spread between these two. And so obviously when you look at this, you can see, okay, the VIX spiked quite a bit over realized earlier. Does that mean that there's too fat of a risk premium, and maybe I want to start to sell options? So if VIX goes to 65, do you want to start selling vol in that situation, right? Just because that premium is so fat. Chris Adil would probably make fun of us for suggesting that, and I think a lot of the vol guys would throw shade on that idea. But kind of to your point, the vol premium expands and contracts, and so that can tell us how well the market is hedged or if it's not hedged enough. So the confusing thing here is I would say that this looks like a fat vol premium, right? Because you say realized vol is at 16 and VIX is at 22, so that 6 points of premium is pretty healthy. But I don't think that this is doing a really fair job, meaning realized vol is doing a fair job of suggesting or showing us what the actual embedded risk is, right? Because when you look at the intraday swings, they're very large, and that doesn't necessarily show up in realized vol metrics.
On this next slide, you've got this the lows of the new normal.
Yes. So the Saul Goodman to injured Saul Goodman really comes in this idea that the market is, I think, underpricing risk in a significant way in this market at this time. And the idea is that we had a ton of volatility, right? Everyone's well aware of that. We're still getting these giant intraday trading ranges. We've now moved to a greed cycle with the market, ripping. But as far as I can tell, there hasn't been the solving of the kind of known unknowns has not happened. So typically a crisis ends when the Fed comes out and does what they have to do with rates. Either they stop raising them or they cut them, or there's some type of government response, or in this case, we signed tariff deals with China, which seems to be a big thing, and we can all move on with our lives. And we really haven't gotten that, right? And so the idea was entering a new volatility regime. And so I know there's a lot of lines on this chart, but what I want you to just sort of do is we have correlation. We've talked about this a lot in the past, is the SIBO correlation metric, which just tells us, are stocks moving together or are they, moving in distinct ways? And so the general idea is that in high risk environments, NVIDIA, Apple, Tesla, they all trade in the same direction. In very, very bullish environments like late last year or towards the middle of last year, I guess about a year ago now, you would see like NVIDIA outpacing all other stocks by like 20%, right? When you see that, correlation drops. Then you also have VVIX, which is the vol. We have the VIX on here, and then we have the skew index. So what's the value of an out of the money put versus an at the money put? All of these levels are basically just where we were for essentially most of the post-COVID period, right? So if you're going to say what was the anomaly in this chart, I look at this and I go, well, it's 2024 largely, right? From basically the start of 2024 to mid last year. That was actually the anomaly. This excess bullish period that we had, driven by the AI semiconductor chase, right? That was the crazy period. And now we've really just sort of arguably normalized to where vol was in the kind of post-pandemic era. And that makes a lot of sense to me when you think about now having stable volatility, because we have, even if we solve the tariff issue tomorrow, maybe if I don't know if we could get pen to paper tomorrow on a deal with China. Maybe we do, and then this whole thing goes away. But if we don't, what are the economic impacts of this? Like Trump still wants rates down, and all these other things. So there's a lot of uncertainty out there, with respect to these, different policies. And so that to me says we should command more volatility premium here, which means that these levels, which are sharply down from April highs, they're kind of just where we were for 2020 to 2023. So this is the kind of, maybe this is all the mean reversion we're getting in terms of volatility.
Yeah, and this also echoes what Cressidio was saying, which is he came into this year expecting like an above average volatility year, and we got that, and this is not something it seems like either one of you is thinking is just gonna head right back down to where it started.
Yeah, and again, it's very hard to not let a macro view bake into this. And my second concern here is this idea of liquidity. And so we talked about this in April. You mentioned we just talked about this with Chris recently. This is that same CME liquidity tool chart that we mentioned before, and this is the April low. You can see, hopefully you can see where I'm pointing. On the right, here's a chart from Goldman Sachs. This was from the peak of the crisis, really, and meaning early April, right? And what they showed here was that E-mini top of book liquidity went as low as, I believe they said, in 20 years. You can see it's basically the lowest in the modern era. And that syncs right here with the lows that we had on this book depth chart, right? But at that same time, equity volume hit all-time highs, as you can see on that chart. I believe that was the largest equity volume ever. So you had volumes go crazy, liquidity go just dry way up. Options volume at the same time was hitting records. And so the liquidity just totally evaporated, right? And this purple line is the bid-ask spread in the E-mini futures market, right? And what you can see here is that there's a pretty clear bound through the last 2 years. This is the farthest back this goes on this chart. And we've maintained a higher level of bid-ask spread. So liquidity in the E-minis is not returned. It's up off of those lows, but it's far from, where we were a year ago, for example. So the liquidity is still not there. And the problem is that when you have poor liquidity and you have record options volume, stock volume, I don't know if it's still going to maintain, but options volume only continues to increase. Though hedging flows associated with options are kind of like, they're not margin calls, but when you get a margin call, your broker calls you and says, Jack, you're getting out of this position, buddy. I don't care what you got to do. Like 345, we're just going to push your orders out there, right? You're a price insensitive trader at that point. You're just going to get the liquidity. You can't, they don't let you VWAP out of your margin call, right? So a market maker in a hedging position, when they have to hedge because the market's moving quite fast, is sometimes, I think, in that same thing. They are a liquidity taker, and they sometimes have to be an aggressive liquidity taker in a fast market with lots of volume. So you have those types of flows increasing into a market with much lower relative liquidity. If you look at the relative liquidity, though, in December of last year, it still wasn't very good, right? You remember when Powell came out in mid-December last year and it really spooked the market? We had like a big drawdown, right? And vol spiked. And you look back to August of last year, Jack, as you can see right here, same thing. Liquidity evaporated, and then what happened? VIX went to 60, right? And of course, didn't really trade there, bro, and all that sort of stuff. But the index marked at that level, right? That was a liquidity event. And I don't care what you say, the VIX really spiked to a pretty incredible level. Throw shade on 50 versus 60, whatever it is, it was a big VIX spike driven by a lack of liquidity. Around, in that case, it was the yen carry trade thing. In this case, it was a whole bunch of other flows, basis trades, or whatever you want to blame it on. So forced trading into poor liquidity is what makes volatility events. And the liquidity,
Yeah, and I think,
sorry, let's just make this last point. Liquidity is not returning.
Yeah, and I think there's a good underlying point here in the difference between volume and liquidity, because people like me who sit outside this space think volume is like a measure of liquidity. I remember I was trying to do a paper like a long time ago where I was going to like verify Mike Green's work around this idea that these bigger companies are more impacted by passive flows. And like I did this whole analysis and I had this great conclusion, but my big mistake was I had used volume as my measure of how liquid these stocks are, and that's not a measure really of how liquid they are.
Yeah, I mean, it's a great point. And the options market felt like it was actually pretty liquid, and that's an anecdotal statement through a lot of this drawdown. But in those environments, they do great because they widen their bids and offers way out, and the amount of liquidity they post drops. And again, it's because people are coming to them to trade. They collect that spread, and it's great for them. But this record volume into that lowest liquidity tells you that people were being, they're forcing trades out there is what that is. And that is all, that's all big transaction costs for people, right? That makes it very expensive to trade in that environment, but you don't have a choice. You got to trade, right, in some of those situations. And so, there's a lot of alpha decay in there for people who are trying to put together decent strategies through those periods.
So this next slide gets to what we talked about earlier, which is these record highs in option volumes.
Yeah, and again, the point here is a great tailwind for us as we keep doing our monthly podcast, because more volumes equals more importance, I think. But overall, the point is that these options flows invoke hedging flows in the underlying stock, and that's increasing into lower liquidity. And so I think that makes the importance of these options flows, more critical to pay attention to.
And this next one, you're dealing with the fragility of the VIX.
Right. On this chart is 30 years of VIX tradings, right? And the VIX ultimately is an expression of how much the market thinks, how much traders think the S&P is going to move, right? That's kind of what the end of the day the VIX is really telling us. And so you can go back here to the internet bubble, and the VIX spiked to 50, and then 5-6 years later it spiked to 50 again. And then we had the 2008 crisis where the VIX went to 95. And then, there's a few more little periods every 5-6 years or so, right? There's a decent little VIX spike. Obviously, with the COVID crash in 2020, VIX went to 85, and then a lot of calm. And then we had the VIX in August of just 6 months ago, maybe a little bit more now, time is flying on me, where VIX went to 65. And then we just had another VIX 60 here about a month ago. And so 2 data points does not make, much of a statistical certainty, right? But the point here is that it feels like this lack of liquidity is starting to show up in the vol of vol, meaning VIX needs ultimately low liquidity in bids and offers to widen out, right, as vol jumps in order to start printing at this plus 50 number. And again, 2 data points don't make a trend here, but the idea is that this is to me, a signal that the liquidity is drying up. And when you have that lower liquidity, you get these higher, these volatility spasms, right? And that really starts to show up. And I wanted to bring this. You and I talked, I think, briefly with Chris about this paper written by Chris Cole from Artemis. And Artemis doesn't really exist in the same way it used to, but he used to write these awesome papers, right? And I think he was sort of the godfather of writing pictures of, like, those Roman kind of like Gothic pictures or whatever. And he writes this really interesting thing. And you knew about the David Foster Wallace poem, right? And that's what he starts us off with, or it was a speech, I guess, right? And the joke is about, it's the fish. 2 fish are swimming along. One says, "How's the water?" And the other one goes, "What's water?" Right? Those are the 2 fish. And so what Chris wrote about this, and I just think it's super fascinating. And, because I'm reading this, probably means the market's just going to rip and nothing will ever happen, and volatility goes to 0 and we get bored. But he writes, "Volatility is the failure of the meeting, the crumpling of a reality we thought we knew to a new truth. It's the moment where we learn that we are fish living in a false reality called water, and that reality can change, and there are other realities. True volatility isn't the change of a thing, it's the changing of the medium around it, and it's the realization that the thing never really existed in the first place." That's like a very dire statement. But what he goes on to say is, this is all you need to know to understand when the volatility storm will truly come. It's not about valuations, money printing, or where the VIX will be. It's the consciousness so that you can stop believing the growth, essentially, of liquidity. And so the idea here, as I just sort of move off this a little bit, is that liquidity, when it dries up, is when true volatility really starts to emerge, right? And he calls it the fragility of the market medium. And I don't know that I'm at so much end of days as Chris was maybe in this July 2018 paper, but it brings up a lot of interesting ideas when you start to look at the liquidity here and the volatility spikes we're getting, and the movement around Trump's tweets and kind of the pain that was, invoked. And so, this all kind of brings up this idea that, yes, the VIX is still elevated right now, but if we're at this new stable norm, then owning put protection here or hedging that downside risk, which could be very material, makes a lot of sense, right? Particularly as we move into this very large June options expiration.
And for anybody who hasn't watched it, I would really recommend that David Foster Wallace commencement speech. This is water. It's on YouTube, and it's really, really good. I've watched that at least a few times.
Yeah, it's great, and I can include a link to this paper as well. It's really fascinating when you read this because it's from 10 years ago, and you think about all the things that have happened here, and reflexivity and liquidity and those types of things that we've talked about here today.
So if I was a stronger host, Brent, I could probably segue from David Foster Wallace to Bitcoin, but unfortunately, I cannot do this. You might have to just come up with something to lead into your Bitcoin breakout slide.
Oh my gosh. I just go from like, look, the world is about to end sounding to Bitcoin. But I believe we touched on this in April, and if we didn't, it was in another video I did, probably just talking to myself on screen like I normally do. But one of the most surprising things to me, and I know I talked about this with Chris too, is that do you track Bitcoin, Chris? And I don't know if that made the cut in your editing there, but Bitcoin vol was the lowest volatility of any asset through the whole crisis, which was over the last month. It was shocking to me. Like S&P vol is going crazy, single stock vol is going crazy, all these different, bond vols going crazy. And Bitcoin vols like just slept through the whole thing. And like, as you can see here, like there was a pretty good 20% drawdown in Bitcoin. So I don't want to say that like nothing happened, but it was the lowest vol asset that we monitor. And as you can see here, it has just gone absolutely bananas. It's ripping now. And, today we're over 103,000. And again, this is one of those situations where we're going to go into the macro here. The argument being that it's a neutral asset that we all go into, or whatever it is. I'm not even going to start to wax poetically why, but it's certainly very interesting, because normally if you're going to ask me what would Bitcoin vol do if VIX just went to 60, I would be like, well, Bitcoin vol must be at like 200, right? But it was very stable, and now we're seeing obviously a significant rally here. And just being objective and looking at the data, this is what we call our compass from SpotGamma. All you're getting here is implied vol on the y-axis. So if it has high implied vol versus low implied vol, that's the XY. And then left to right is our call price is high. So that shows up on the right side of this chart. Our put price is high. That shows up on the left side of this chart. Does that make sense?
Yeah.
So a lot of these names here have high put prices, but low implied vol rank. So puts are a little bit rich relative to calls, but the options overall aren't expensive, right? So we're talking about skew when we look left to right. And if you remember, before we showed gold, right, in April, and gold was way up at the middle of this chart, which told us that options were really rich. They're a little bit skewed towards expensive calls, but that was kind of our topping signal. In this case, what we've seen is Bitcoin has gone from the lower left of this chart, where puts were expensive, to, or puts were relatively hard, to calls are now relatively rich, but implied vol has not really lifted. And so if we were going to say, when does this Bitcoin move over, it would be when that implied vol really starts to lift. And that's what would be signaled as we're trying to show on this chart here, where all of a sudden stock of vol up hits. And when that generally hits, the telling us calls get too rich. And that's usually a topping signal for something like Bitcoin. So that doesn't mean Bitcoin can't just sell off because of something not related to the options market. But if we're sitting here in call options, in IBIT or MicroStrategy, it's fairly comfortable, and there's not a great reason to sell them, because the asset's moving up and we haven't really gotten that big vol lift. And generally that vol lift comes when the trade gets very crowded. And so on that point, MicroStrategy was something that we were dunking on a lot late last year. You're starting to see those posts come back in X, right? Like, I put my whole retirement account into MicroStrategy because blah, blah, blah. And hey, those people are winning right now, as much as I kind of made fun of them. They looked like, jerks earlier this year, but now with MicroStrategy at 400 and Bitcoin ripping again, they're kind of creeping back out of the woodwork. So when you get more of that chorus showing up, you'll see that implied vol get rich, and I think that'll be kind of a topping signal. So that is kind of the one thing that we're really paying a lot of attention to here, because that volatility is really starting to creep up, and it's becoming a really interesting moment for Bitcoin.
Yeah, an interesting thing on Bitcoin. And again, I don't have any macro reviews, just like you don't either. But the idea, you have kind of two camps on Bitcoin. It's the leveraged NASDAQ, and then it's the new version of gold. And this is sort of the first period we've gone through where the price action kind of gave you some evidence for the new version of gold versus just the leveraged NASDAQ, because it did decouple from the NASDAQ.
Yeah.
For the first time, or at least in a significant period that I remember in a while.
Yeah. I mean, absolutely. And to your point too, like, there's trying to figure out why it's happening. And there's a couple of good narratives around there. And then at the other side of the equation, the option space, sometimes you just buy options because they seem cheap, right? And there's a realistic chance that, the asset starts to move. And to the same point, when options seem expensive, that could be maybe an opportunity to sell. And so in gold, it was very rich. Bitcoin is starting to creep up a little bit in terms of expense, but the move from this perspective doesn't seem to be overstated, which is very interesting because I don't know. You could have a situation where Trump signs a trade deal and then it's risk on, and then Bitcoin seems like it'll go up, and then you could also have a situation where we're all fighting, all the countries are still arguing with each other, and people just want to own Bitcoin because it's not a country related currency or whatever. So to your point, I don't know, but there's a bunch of interesting scenarios that you could play out where Bitcoin does just keeps rocking here. So really interesting moment, and be fun to update this for the next OPEX effect.
Yeah, and as we wrap up, we always like to look at some upcoming events and the path forward.
Yeah, so we have May OPEX next Friday, and then VIX expiration follows that. There's also CPI on the 13th, and we have the China-US talk we've already mentioned about 10 times here, right? So there's a lot happening the next couple of days, but for me, there's the opportunity for this to be a turning point. But honestly, if they sign or if they have some big advancement and the CPI is no big deal, then it's going to be hard to say, hey, we're going to see an extended short period out of this options expiration. Statistically, we should have some mean reversion. The market should correct here. The more interesting thing is going to be into June OPEX, right? Because those are where the really, really big positions sit. You start talking about the JP Morgan collar again, those kinds of things into the end of June. And so that has the opportunity to really attract price and really drive returns, both to the upside and downside. And so when we're looking here, that 5,900 to 6,000 as a possible upside scenario into June OPEX makes sense to us based on positioning. And then to the downside, we're really looking at the 530 area because that spider positioning, where all those puts sit, kind of into that 5,000. Obviously, if we're going to drop that much, you're going to have a pretty wide range of outcomes there. But that 5,300 is the big downside target for us. And if any bad news, like if the China medias go well, if the CPI comes in a little bit hot, something like that, then we think there's easily move down into that 5,300 area on tap.
So I think the takeaway is people need to set their calendar to watch us in June because things can get wild here over the OPEX effect.
We did Scorched Earth, Saul Goodman, Port Twitter, Bitcoin call. So we made a lot of calls here. So a lot of opportunity for people to make fun of us in the comments.
Which they will. I've learned as the channel gets bigger that is something they're going to go ahead and do.
Right.
So just as a sort of some housekeeping here, we are going to do these now on Friday before the week of OPEX. Going forward. That way we can do them a little bit more of a preview as to what's coming up in the future.
That's right. And so I love that idea. And if you're interested in getting the slide deck or signing up for more of this, you go to spotgamma.com/OPEX, so OPEX. You can get, again, the slide deck, and then we will be updating some of these expiration slides next week, obviously, as some of the positions change into OPEX itself.
Yeah, if you didn't like any of the content, make sure to comment about Brent in the comments, because even if you do it, the algorithm likes comments. So right. The negative stuff, the positive stuff, we'll take it all.
Yeah, and I won't be reading the comments anyway, so say what you want.
Yeah, no, I don't really read them either. On that note, thank you everybody for joining us, and we'll see you next time.
Thanks, Jack.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Jack Forehand is a principal at Validity Capital Management. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital.